this video today is how to calculate income for someone who is self-employed. One of the biggest mysteries today in the mortgage lending industry, of course, is when somebody is self-employed, how do we calculate their income in order to qualify them for a loan? Self-employed people tend to write a lot of things off. They tend to have a lot of deductions, write-offs, and expenses. And because of this, and because of how my industry does the job, it never works out too good for self-employed people. So watch this one here. So for example, self-employed person, let's pretend they get a 1099. Let's pretend you're a real estate agent, okay? A 1099 is the gross payout of your brokerage to you. So what happens is a real estate agent gets paid a 1099 for $80,000. That's their 1099. So I'm showing you right now, why do self-employed people have such a hard time qualifying for a loan? I'm showing this to you right now, okay? They get a 1099 for $80,000. $80,000 is your 1099. What they do is they have these little things called deductions. Okay, for example, meals and entertainment, they write off $10,000. Okay, that's meals and entertainment. They write off $20,000 in business miles. That's 20 grand written off there. They write off advertising, marketing, $40,000 in marketing and advertising. The next thing you know, here's all their expenses and deductions. Here's their income. 80 minus 10 is 70, minus 20 is 50, minus 40 is 10. Their net income is $10,000. So basically they are telling the Internal Revenue Service, I only made $10,000. When they talk to people, they'll say, I make $80,000. So you talk to somebody self-employed, a lot of times how much they make or how much they say they make is the big number at the top. But in my world of lending, it's not about the big number at the top. It's about the little number at the bottom. It's this $10,000. On $10,000 of income, I'm sorry, you don't qualify for anything, okay? Now, everything I'm talking to today is for traditional, conventional FHA, VA, USDA lending. There are some other programs out there called non-QM loans, also known as bank statement loans. They have a few things like that. I'm staying away from those things, okay? I'm staying with the traditional loans, which encompass the majority of the loans done in the United States, and this is the best way to go. So these are the deductions. This is the income deductions. This is what's left. This is why a lot of self-employed people do not qualify. They write off too much stuff, too many deductions. The only solution to that is to raise your income. Raise your income and cut your expenses. You raise this number, you reduce your expenses, you increase this number. This is the only solution. Now the question is, now this is more directed at loan officers now. As a loan officer, how do you calculate the income for somebody self-employed? If you're self-employed and you're watching this video right now, you could do this yourself too, by the way. This is not brain surgery. This is not rocket science, okay? This is pretty easy and basic, but to get to this level took a lot of reading, a lot of research, and a lot of studying of guidelines. So follow me on this. So if you're a loan officer, these are the documents you want to ask from the customer. If you're a customer, this is what you want to produce. What I start with is I put P&L over here. That's a profit and loss. So you want to write down on one side of your paper P&L, which stands for profit and loss. Okay, you got a P&L. Over here, you want to write down the year 2020, like so. Now, mind you, at the time I'm doing this video right now, it's 2021. In 5 years from now, this video is still going to be sitting on the internet. I think it will be. And in 5 years from now, of course, it's the year 2026. So in the year 2026, it's your 2024, 2025 tax returns. For right now, I'm going with your 2019 and your 2020 returns. The next step you want to do is you want to write down the word gross. I write down the word gross, and then I write down the word net, like so. I write down gross, I write down net. This is the calculation of how you calculate somebody's income for being self-employed. You will pull up their 2019 tax return and their 2020. For purposes of what I'm talking about right now, I will only talk about Schedule Cs. Schedule Cs are filed as a sole proprietor on your personal tax return. And again, that's your Schedule C. So if you're watching me right now and you own a business, you own a corporation, good, you're going to have to watch my next video where I do income calculations for people who own corporations. But if I gave up all that information right now, I'd give you all my secrets and you wouldn't be watching my next video. I need to drive up those subscribers on YouTube. So you gotta like, share, and subscribe too, by the way. But anyways, that's beside the point. I've got gross, I've got net. In 2019, your gross was $40,000. So you write down 40K on your tax return. In 2020, your gross was 60K, like so. That's your gross. Your profit and loss for 2021, I'm writing it down like this. Forgive my writing, it gets a little sloppier. Sometimes it's turned sideways. These boards are only so wide. But for 2021, your gross through, let's just pretend it's through October. I'm going to put through October 10/31. Your gross through October 31st is 70K through October of this year. So through 2021, my gross is $70,000. What that means is I'm averaging $7,000 a month. The pace that I'm on for 2021 is 84K. That's the pace that I'm on, okay? My profit and loss would show that I'm on pace to gross $84,000. My gross in 19 was 40, my gross in 20 was 60, my year to date is 70, the pace is 84. 70,000 through 10 months is 7,000 a month. Annualized over a year, I'm on pace for $84,000. That's my gross. Let's look at nets. I grossed 40, my net was 25. I grossed 60, my net was 40. I'm on pace to gross 84. Let's just say I'm on pace to net 60. Now you have to pay real close attention to this, everybody, because this is super important, okay? In 2019, my gross was 40, my net was 25. In 20, my gross was 60, my net was 40. In 2021, I'm on pace to gross 84, I'm on pace to net 60. This is how we calculate the income. There's two steps you have to pay attention to, okay? And there's two questions you want to write down, actually. These are two questions you want to ask, and if you're writing this down at home, write these two questions down. Question one, is the gross income increasing, is staying the same or increasing year over year? Is the gross income staying the same or increasing year over year? Keep in mind, you want your income at least staying the same, if not going up. A business whose income is going down, you're not going in the right direction, okay? But trust me, I've been in business 22 years. I spent a lot more time going down than I've spent going up. And that's the way it is, and business owners understand that. But nonetheless, is the income year over year staying the same or increasing? The gross income. It's the same question for the net income. I told you there's two questions, gross and net. The question for the net is the net income year over year staying the same or increasing? That's for the net income. In the example I'm showing you, the gross was 40, 60, on pace for 84. That's increasing. The net income, 25 to 40, on pace to 60. The answer is yes. If the answer is yes to both questions, the income is staying the same or increasing. In this example, it's increasing. The income is increasing as we go across time. Then I can use the income. If I can use the income, here's what I do. I average this number plus this number, which is $65,000, divided by 24 months. That gives me the gross monthly income. And because I generally don't have my calculator, well, I don't have my calculator with me, but that's okay. Generally speaking, just generally, $65,000 over 24 months is somewhere in the vicinity of probably just under $3,000 a month. So it's just under $3,000 a month, probably $2,800 a month. Just take your calculator, 65,000 divided by 24. The monthly income to use then is $3,000 a month. So the monthly income to use is about $3,000 a month. Again, this individual would say, Khash, but I'm going to make $84,000 this year. Why are you using $3,000 a month, which is $36,000 a year? Simple. Number one, we only use the net income for the income. We don't use the big number, we use the small number. We don't use the big, we use the small. Second reason is we average the income over a 2-year period. 25,000 plus 40,000, average it out over a 2-year period, just under $3,000. So again, your average self-employed person, and by the way, most loan officers out there are going to simply say, hey, this guy made 40, made 60, he's going to make $84,000. We'll use $84,000. You're in for a disaster, okay? Do not calculate income that way. If you're a loan officer watching this right now, the 2 questions you ask the customer, well, the documents you ask for, their last 2 years of filed returns. You take their gross incomes, you take their net incomes, you see, is the income staying the same or increasing year over year? If the answer is yes here, you can use it. You add these 2 numbers, you divide it by 2 years, there's your monthly income. Now, there's going to be some loan officer on here saying, Khash, but wait a second, Freddie Mac has a program where it waives 2 years, you only need what? Okay, fine. Okay. There are some exceptions to what I'm showing, but for purposes of this video, I'm not going to talk about them. You know why? Because this is the right way to do it and the right way to go into it mathematically and mentally. I always tell people this: take the most conservative approach to calculating income. If you take the most conservative approach to calculating income, you got nothing to worry about. If you want to play this like it's the Wild West, okay, as we used to say at Oklahoma State University, cowboy up, well then by all means we can start waiving this. We can get an audited profit and loss and use this, which by the way, you do not use the income from the profit and loss. Let me tell you that again. You do not use the income from the profit and loss because until this is filed, it does not exist. You have to listen to what I just said again. Until this profit and loss is filed, which by the way, you don't file profit and losses, you file tax returns. Until this is filed, this does not exist. That's why for income purposes, we use these numbers. To make sure the business is operating this year as it did last year and in previous years, we analyze the profit and loss. This is how you calculate the income for a self-employed individual. One more time, I want your last 2 years of filed returns. I want a profit and loss year to date. I take the gross incomes here. I annualize the gross income, the pace that we're on here. I take the net incomes here. I ask 2 simple questions. Are the grosses staying the same or increasing? Are the nets staying the same or increasing? If they are, which they are here, I take the nets on the filed returns. I divide it out by 24 months, and that's my usable income. Keep in mind, this person's saying, Khash, I'm going to make $84,000. That's $7,000 a month. I'm only using $3,000. This is why self-employed people have such a hard time going through this information. So at the end of the day, this is what we want to pay attention to. Now here's an offshoot of this. An offshoot is this one. Let's pretend that this year the income was $10,000 net. So the income went from 25 to 10. Now they're pacing for higher. The most conservative approach is declining the loan. The income year over year declined too much. I can't use it at all. Even if you were to say, but Khash, this year I'm turning it around. Until this year is filed with the Internal Revenue Service, it doesn't exist. Believe it or not, this could be a shocker. We've had people, I personally had a lot of people, provide me with documentation that's not actually accurate, okay? So this stuff has to be filed. If this is declining year over year, I'm telling you right now, go talk to your parents to get them to co-sign for you, because that's when you're going to need a co-signer who brings more income. So for self-employed people, staying the same or increasing, average it across 2 years. If it's declining year over year, do not use it at all. Again, are there exceptions to declining income? There are exceptions, but for those, you want to call me on the phone or keep watching more videos, because I do have videos on exceptions and things like that. But this is calculating income for a self-employed individual. Gross to gross, net to net, 2 years of returns, profit and loss shows us if we're on track to make the same or go up. The answer is yes. Add it up, average it. That's how we do it. If it's declining, throw it out the window, come back later. Hopefully that makes sense, and that's your tutorial on how to calculate income for self-employed individuals.